Hi everyone, Matt from Stocktrades here. Income investing has become quite popular over the past number of years, and here at Stocktrades we get a ton of questions about dividend stocks. One question that usually comes up is whether or not the dividend is safe, and this is particularly relevant for those with a high yield. What we're going to do today, we're going to look at 3 stocks, and we're going to walk you through our thought process and help you determine whether or not the dividend is sustainable, or perhaps if a dividend cut is upcoming. The first stock we're going to look at is Interpipeline. Full disclosure, I'm long Interpipeline. I like the company, but for today's purposes, we are only going to look at the dividend. Is the 8% dividend yield safe? At first glance, if you look at the chart, you'll see that the 8% is near an all-time high. This is never a good sign. This is in spite of the fact that Interpipeline is a Canadian dividend aristocrat. This means that it has raised dividends for at least 5 consecutive years. As you can see in the chart, it has steady raised dividends and it has an 11-year dividend growth streak. This by itself doesn't mean anything. There are several times and several instances where aristocrats have cut their dividend. In fact, in 2019, 15 companies fell off the list. So when you're looking at a dividend and you're looking at investing in a company, a long-term dividend growth streak, although it's a positive, this doesn't mean that the dividend is safe. Another warning sign for Interpipeline is that in 2019, the company didn't in fact raise a dividend. However, since it paid out more in 2019 than it did in 2018, it technically kept its dividend growth streak aligned. Higher than average yield, and the company didn't raise dividends last year. 2 potential red flags for investors. Now, let's look at the payout ratios. First thing you're going to look at is a dividend payout ratio as a percentage of earnings. What do you see? 118%. Ouch, that could be a problem, right? That means that the company is paying out more in dividends than earnings. However, we've already determined that this alone isn't enough to determine the safety of the dividend. We need to dig deeper, especially for pipelines. So in this case, we are going to look at cash flow. As a percentage of operating cash flow, Interpipeline payout ratio is 37%. This is much better than 118%. However, we're going to keep digging deeper. We're going to look at free cash flow. And what do we see? We see a negative free cash flow. This is a bad sign. This means that the company is in effect borrowing to pay the dividend. That means that the company's operating expenses aren't enough to cover its capital expenditures and its dividend. In Inter's case, this is for one reason: the Heartland petrochemical plant that it's building. It is a very ambitious project and it's supposed to add significantly to earnings before interest and taxes in 2021. However, the company needs to get there first. The company is borrowing a ton of money and is highly indebted. This is why the company didn't raise dividends last year. It is taking a prudent approach. As mentioned previously, some companies like to create their own version of free cash flow. In Inter's case, they like to compare the dividend against fee-based and cost of service cash flows, minus sustaining capital. You'll notice here that they didn't add or include CapEx, so capital expenditures. Sustaining capital and capital expenditures are a little bit different. In Interpipeline's case, sustaining capital is ongoing maintenance capital requirements. However, they are building a $3.5 billion petrochemical plant that is not included in this. Of the $3.5 billion, the company is still on the hook for approximately $1.3 billion of this capital expenditure. Now, this isn't included in their sustaining capital. So when the company says that the dividend currently accounts for 80% of their free cash flow, this doesn't take into account the $1.3 billion that they still need for the Heartland petrochemical plant. That means they are borrowing that money. The good news is that the company currently seems to have enough cash on hand to make this happen. It has $1.2 billion left on this credit facility, and it is expected to generate approximately $700 million in operating cash flow over the next 2 years. This should be sufficient to cover the remaining capital expenditures on Heartland. However, it's a very fine line here. And I think this is why the company decided not to raise a dividend this past year. So with that in mind, is the dividend safe? I wouldn't go out on a limb and say 100% that the company's dividend is safe. It has very little room for error with respect to the petrochemical plant. If the capital expenditures come in above budget, that means it's going to have to borrow or it's going to have to issue shares to cover that shortfall. This is already a company that is in significant amount of debt, so it has very little wiggle room. And so long as a company can deliver Heartland on budget and on time, I believe the dividend may be sustainable. Next up, we have Ark Resources. Ark is an independent oil and gas company based in Western Canada. Although it produces a wide variety of liquids, its primary source of revenue is natural gas. It accounts for approximately 73% of production. Over the past 5 years, Ark has struggled. It has lost 75% of its value, so it's not surprising that its dividend yield has shot upwards. At the heart of the issue, the price of natural gas. Although we've talked about payout ratios, we've talked about cash flow, we've talked about capital expenditures, what we didn't talk about is the impact of macro events on a company's ability to pay a dividend. Price of natural gas is a great example of a macro event that is impacting Ark Resources. If you take a look at the chart, Ark Resources' dividend yield is near all-time high. Although it is down from the above 10% yield it had previously, it is still in and around 8.5%. This is a very high yield. If we look at the company's payout ratio, you'll see another red flag. First and foremost, the dividend accounts for 150% of earnings. Once again, not great. However, the dividend accounts for only 30% of operational cash flow. That's a good sign. Digging a little bit deeper, you'll see negative free cash flow. However, unlike Interpipeline, Ark Resources is at the tail end of its big capital expenditure program. That means that capital expenditures are expected to drop over the next couple of years. In fact, in 2020, the company estimates that capital expenditures will be approximately $200 million less than in 2019. 200 million, that's enough to cover the dividend right there. So the payout ratios told us one thing. However, if you look forward, the payout ratios would look entirely different. So it's important to note that payout ratios are only historical. It's also important to look forward. Speaking about looking forward, the price of natural gas. This is going to be the single biggest factor on Ark's ability to sustain and maintain the company's dividend. As of today, the price of natural gas is near an all-time low. This is significantly impacting the company's profitability and the company's ability to generate cash flow. However, since the company has little debt, it is better positioned than most to navigate the current natural gas bear market. Is the dividend safe? The company does have a history of dividend cuts. This isn't like Interpipeline, who has a long and storied history of dividend growth. As recently as 2016, Ark significantly cut its dividend. If you'll notice on the chart, it actually aligns quite closely with the all-time low of natural gas. So the last time the price of natural gas was this low, the company cut its dividend in a big way. Will it do so again this year? Not necessarily. As mentioned, it is reducing its capital expenditures. It has little debt, so it is in a good position. However, the company may take a prudent approach and cut the dividend. In this case, it's all about the price of natural gas. Management will make the decision that's in the best long-term interest of the company. Next up, we're going to take a look at Canadian Imperial Bank of Commerce. Why did I choose CIBC? I wanted to look at a different sector, and with banks in particular, I did mention at the beginning that banks generated negative free cash flow. So it's important to look at banks from a different perspective. CIBC has historically always had a higher dividend yield than its peers. Today, the current yield is at about 5% or just above 5%, which in some cases is almost 200 basis points higher than some of its peers. So is the dividend safe? As mentioned previously, it is best practice to look at the dividend against earnings. Since operating cash flow tends to fluctuate greatly, and free cash flow is typically negative or non-existent, it is better to look at the company's dividend in relation to earnings. And for banks, this is a very easy process. You'll want to look at the dividend as compared to its peers. You'll want to look at the dividend as compared to its own historical averages. As of today, CIBC has a payout ratio of approximately 50%. This is right in line with the average. In Canada, the banking average dividend payout ratio is 49%. So although CIBC may be slightly above this, it is right in line with that average. Secondly, if you look at the chart, CIBC's payout ratio has actually been on a decline. It reached a high just above 60% at the beginning of the decade, and over the past number of years, it has actually been on a decline. So from this perspective, even at 50%, even above average, CIBC's yield is still well below its historical average. Not only that, over the past decade, CIBC has been able to raise a dividend. So even though the payout ratio has been on a decline, The company has also raised dividends. This is a positive sign. This means that CIBC has been able to generate increased income to offset the increase in dividend. Now, on a historical basis, everything looks great. However, for these companies, you'll also want to look at the projected growth rates. After all, if the company is expected to post negative growth rates, that payout ratio is going to skyrocket pretty quickly. However, if the company is expected to grow earnings, then this payout ratio should remain relatively stable, so long as the rate of dividend growth matches that of earnings growth. In CIBC's case, unfortunately, analysts are expecting a slight decrease year over year in earnings per share. In fact, over the next couple of years, they're expecting earnings to drop by approximately 1 or 2%. This isn't the end of the world. This isn't going to put their dividend at jeopardy. Over the long term, they expect approximately 3 to 4% earnings growth. So long as the dividend matches this earnings growth, the payout ratio should remain relatively stable. So with that in mind, is CIBC's dividend safe? Absolutely. Despite the fact that it pays a higher than average dividend compared to its peers, the dividend is well covered by earnings. It is well in line with historical averages. It's well in line with the industry average, and looking forward, the company is still expected to grow earnings. There are no real red flags here. If you're looking for a safe stock or a safe dividend, go to Canada's banks. They have the safest dividends in the country. And that brings us to the end of our video. Hopefully, you have a better understanding of how to evaluate the safety of a dividend. Just remember, a single point of data in isolation doesn't give you the full picture. You need to dig deeper. Look at cash flows. Look at the company's history. Look at the macro events. Compare it against industry peers. There are several steps to take in determining the safety of the dividend. The payout ratio is not enough. Likewise, as we've seen with some of the companies we've looked at today, a high yield can also be a warning sign. So it's important for investors to properly do their due diligence. With that in mind, like the video, subscribe, and comment below. I'm particularly interested in hearing which high yield stocks do you think are on the verge of a dividend cut, or which stocks do you think have a high yield but whose dividend is safe and sustainable over the long term. Thanks everyone, till next time.